Welcome. Another AMA Ask Me Anything Wednesday, I believe it is. It seems like it's Wednesday hump day. We're going to have some fun. We're going to answer some questions. We got 3 pre-submitted questions. We have other questions coming in. We're going to go around the horn. This might be 5 of us today, so we're not quite Brady Bunch style, but we're still going to have a lot of fun. I'm sure we're going to learn something. I walk away with a takeaway every week. Write stuff down. I'm challenging you right now. Write stuff down. Learn something, walk away with something new that you're going to apply.
Question 1 is from Eve Page. She said, if funds are sent to an escrow company or the borrower's lawyer, should lenders require something signed, Brian, signed by the borrower before sending funds? Or is it fine to have contracts signed once funds are in escrow?
You could do it after funds are in escrow if it's a legitimate third-party escrow company. I would always verify the escrow company and double verify. Eve, I have a feeling I know what you're referring to, and I would just say pump the brakes.
Yeah, Eve, if you're listening, I think your spidey senses are right. I don't know.
Spidey senses are, we think, right. We don't know yet, but I would certainly, if that spidey senses, are this thing over here, run the other way. But you just generally question, to answer the question, you could send funds to a third-party escrow, preferably an attorney or a title company with an attorney that you have not background check, but just double check. Make sure it's a legitimate title company, an escrow company. Make sure it's a legitimate attorney, which should be very easy to find with Google search. And they can hold the funds. I would probably, if you wanted to get super crazy like I am, I send escrow to my attorney, and then my attorney will send the escrow to their attorney. So just play the attorney. I mean, listen, I live in New York, so maybe that's just a New York thing where everything's done with attorneys here. But just get used to using your own attorney to drive and do everything. It doesn't cost much to have an attorney escrow the funds and control it. That's what I would suggest.
She did have a follow-up question. What can you tell me about lender's insurance? I thought that meant if a borrower defaults for whatever reason, the insurance pays the lender. Looking online, that does not appear to be the case. Online says a lender's policy ensures that the lender's security interest in the property has priority over claims that others may have in your property. A lender's policy does not protect you.
I have never, ever in my entire life, not once said a lender's policy or an insurance policy that we refer to as being additionally insured on pays you if the borrower defaults.
I don't think she's saying you said that. I'm saying she says, what can you tell me about can you tell me about lender's insurance? And then she's saying what she thought and what she found online.
Yeah, it definitely is not even close to what you thought. I mean, there wouldn't be an insurance company in business if that's the kind of insurance they were writing. And if there is one of those and you find one, please let me know. I'll start doing some really risky deals that pay really big returns, knowing the insurance company is just going to make me whole. But that is a pipe dream. It does not exist. Lender's policy is exactly what you said. It's going to protect the property. So, for example, if you're down in the Florida neck of the woods, like Jason, and they get some hurricanes in that area, you could make sure that the property has, the proper insurances, flood insurance and all that, and you could be named additionally insured. So the property you lend on, let's just say the hurricane wipes the property out, that borrower that you lent the money to is going to be in probably a really bad financial place. So wouldn't it be better to have the insurance company pay you instead of that borrower that just lost their property?
And then our last pre-submitted question is one from Brian's client. So we are wanting to start a policy with about $3,500 a month. $1,500 of that premium would be from our vacation fund that we want to put into a separate account per month. Yet if we take out a policy loan for a trip, we don't have the additional cash flow to pay back the loan and the premium. Thoughts on how to structure this?
Yeah, so I just want to get some feedback from the group here and from Chris. Because what this client is doing is they want to fund a policy. They have an amount in mind, about $3,500, but they're taking money from that's going to some retirement accounts, putting it towards here, and then they have $1,500 a month going towards a travel fund, and they want to put that into the policy. But then they realize if they borrow from the policy, have a loan to pay back, they don't have the cash flow now to really pay back the loan and the $3,500 of premium. So they're kind of wondering, they were brainstorming some thoughts. I want to put it out to the group and see what you guys thought.
Question. Can I ask another question, Brian? Sorry, can I ask a question with them? So with them, like, are they saving, like, if it's $1,500 a month, that's like $18,000 a year for their vacation, right? So are they saving $18,000 consistently for vacation every year?
Yep.
And now they're just talking about using the money and then putting it back at, like,
they go on about 4 trips a year. They go 4 trips a year. So they save the cash, spend it, save it, spend it, save it, spend it.
Been there.
Yep. So that's what they're doing. But then they realize that they don't have the additional cash flow to pay back the loan, though. So they're kind of wondering where some thoughts are.
I mean, they have the flex. I'm sure you already told them this, but they have the flexibility with the loan repayment. And, you know, if they're just paying for it and then spending the money and then going back to zero and spending the money and going back to zero, they interrupt compounding interest every time. They're not protected. They don't have all the tax-free growth, all the other things that we know that they have.
Well, they're aware of all that.
So putting it all together makes sense. I think it's just a matter of having them understand, like, hey, you can pay back the loans when you want. It doesn't have to be fill it back up. Like, just if you're going to save the money, put the money you're saving back into the policy as a loan repayment. And I think that gives them more. And then by the time they hit that efficiency point, they'll be making money by taking their trips, right?
They understand all that. Yeah. The challenge is cash flow. It's the cash flow of the current, situation, current income level, and all that kind of stuff to pay back the loan on top of it. So,
well, so if they're consistently doing 18,000 a year, though, and they've been doing that, wouldn't they really only be behind like 1 year then, essentially, because they're already doing that, like, because they put 18,000 aside every year, right?
Correct, but they're spending the money every few months, so they don't have like a big cash savings sitting there right now,
right,
to pay back a loan policy premium. So they're just kind of wondering what are some ways to do that. What's the flexibility? So of course, as we all know, with infinite banking, the loans are flexible. The premiums are also flexible too, to a point, because of the PUAs and stuff. So, so they were trying to do the math, because they're saying, well, do we need to reduce the premium to make sure that we can pay back the loans, all that kind of stuff. And so I have quite a few ideas. I don't know if Chris is talking to us or somebody else, but yeah, a lot of options. Some options is where I'll just put into the group to see.
2 things, and sorry if I'm repeating anything, like I was a little distracted there for a second, but I mean, if you're putting money in a savings account, taking it back out to pay, taking all of it out to fund for vacations, I mean, listen, sometimes just a high yield savings account is maybe the best choice. IBC isn't always the best use for something like that. But let's just say somebody wanted to use the policy because they want the interest rate and they want more death benefit, because it would buy more death benefit. That's a huge piece to this. Then they could use the policy, but instead of taking loans from the policy, just that amount that you're funding it and taking out for vacations, just take withdrawals. Then you don't have to pay anything back. You're not going to get uninterrupted compounding interest on that. But you're still, the big play there would not be the thing we always talk about, which is the spread or the compounding interest. If you're putting it in and withdrawing it out, you're just like a bank account. You're losing the compounding when you withdraw it. But one thing that would do is buy a bunch. I mean, $1,500 a month would buy a bunch more death benefit. So if you care about your family, which sounds like they're taking family vacations, that would be a super. I've never thought about that. I might actually do a wealth webinar on that, because that would be a really interesting thing to see.
Yeah, it was an interesting conversation with them, and they make very good money, but they also have a lot of they live a pretty good life. They have a lot of fun, I guess I would say, and they travel to actually see their kids. So there are kids who are adults and they have grandkids, so they're traveling multiple times, and they're not close locations to go see their kids and stuff. And so they wanted to see how they can combine that travel and that fun, because the one thing they do understand is cash sitting there and then spending it is. They don't like it because they feel like they don't have anything left.
I have an idea, because I it's starting to make more sense as we keep talking about it. Because I kind of do the same thing with my daughter and our trips, but I'm wondering if they did a lesser monthly premium that's more okay for them, and then if they were able to do a dump, because ultimately, once you have that $18,000 or whatever your yearly budget is, like, that's a perfect circle to just keep using and keep doing. And I get that they maybe don't have that infinitely. So would you just do a dump and then just keep reusing that every year?
And like Shauna, that's exactly where I was kind of going with this too. But you talk about it in terms of the dump, but it comes down to capitalizing, and that's what Nelson Nash talked about all the time: is capitalize your policy, capitalize your policy.
Yeah.
And a lot of people don't like to hear that because it means we have to delay what we're going to do with that money. But that capitalization could be maybe you don't take that next trip and you use that for your capitalization period. Or like Shauna said, it's a dump in and you immediately capitalize, and then you can start that circle going where that capitalization pays for the next vacation. And then as you're saving up, that refills it. And you now have the circle going.
Yeah, my thought was another option too is to reduce the premium, take the amount that was the 1,500, put it aside, and do a dump in like in year 2. Which, by the way, we can do those in one of our companies that we work with. You can do a dump in year 2. So do it that way. Do the dump in, jumps up the cash value, gives them that capital to borrow against. But then they also have the cash flow outside to go back into the policy loans. But now they're getting that capitalization there with that dump in, and also getting the policy use by borrowing now and then having the cash flow to pay it back. But yeah, with what Chris said about taking the withdrawals, I never thought about that either. So I actually might go and run some numbers on that too. That's a very interesting way of looking at it too. So
for my trips, it really does work like clockwork. Like I use Harper's policy usually to kind of fund our little Disney trip. And as I sure as shit, by the time November rolls around and we want to go again, I've had it all paid back and I just do it again. But yeah, I guess I get that. All right. Tony Beal is saying, have any of you heard of Tardus Wealth Management and the Income Snowball? Interested on possibly using IBC with and wanted to get your opinions on it.
I don't know Tardus. They're out of Hawaii, I believe.
Yeah, I've heard of them. I just don't know enough about what they do.
Yeah, I've come across them before. I just don't know what that.
Might be worth us just researching it really quick, surface level, and then we can kind of talk educatedly about it.
Yeah, so I was looking up the snowball one because that sounded pretty interesting about it. So I was actually looking it up. I don't quite understand it quite yet, but it's something about using consistency, budgeting, time, a lot of projections. It sounds like it's a process of analyzing your cash flow and stuff, and time. So yeah, I want to look into it now.
I mean, doesn't it sound like the debt snowball and what we're talking about on the front end? We're getting everybody's debts and then using either a snowball or something else. Do you think it sounds like something else?
It sounds like something else.
It's more of an investment strategy where they take a certain pile of money, get it working, and then build that up, add more into it, and snowball it from an investing perspective as opposed to a debt pay down. So,
like a HELOC, like the way that we move the HELOC.
Yeah, it's very similar to what we do with the HELOC and creating spreads and arbitrage. But yeah, I don't know a lot about it, but I had a client ask me about it, and I think they make you pay for the whole strategy of how you set that up, which seemed a little weird to me. But
yeah, it does look like. So I'm looking at the website right now. It does look like they call it, the patented income snowball system. And then there is a guarantee, I guess, that if you don't increase your net worth by more than your membership fee in your first year, we'll give you back your money. Is what they're saying as a money back guarantee, but it does sound like you have to pay them first.
Yeah, and what I was trying to find out what the investments that they're talking about are, and it doesn't say anything about what they are, and just on the front page. So I'd be curious what they're investing in.
Yeah, very interesting.
They're a financial, advisor company.
Okay, Rockstop44 says, I saw your video about flipping forklifts. What about liability insurance for this type of business? This product is a lot riskier than selling simple items like Beanie Babies. The thought doesn't cross my mind at all, Rockstop. So that's my 2 cents.
As long as we can keep Joe out of the warehouse where they actually do the flip, I don't think liability protection is all that important. But if Joe's over there racing them around the place, yeah, you should load up on that liability insurance. I mean, the forklifts never leave a closed environment. They're never outside. They kind of go in a circle like the video shows, and they do them. So I don't really know what could really happen. I mean, even if anything I can think of that would happen to the forklift minus a theft, but I'm sure United Lift has insurance for theft. They would fix. I mean, my God, they take them from Jurassic Park looking machines to practically brand new. So I That's an interesting one. I mean, you could always ask ARC, hey, what's your liability insurance look like? If something happens to these things, someone steals them, the place burns down. I mean, yeah, it's worth it.
But
And by the
Chris,
way, none of us are giving financial advice, investment advice, or any of those things, just in case that wasn't clear. We're just telling what we think and what some of us are doing here. So
I'm just talking about Joe not going in there and racing the forklifts around. That's all I'm.
I may have been racing around, but I wasn't 30 feet up, ducking or dodging a drone.
There's no liability in that, Joe. If I fall from 30 feet up, nobody's got anything to worry about except for the death benefit I've paid out.
But you were having fun.
Edwin is saying, explain how I can fund my policy with 100% of my income, but then I need loans to take out for expenses, but then I have no money to pay back my loans. How is this possible, as stated by Nelson Nash?
Edwin, how long that is true. Edwin, he does say that the ultimate goal is to have all of your money running through your system, right? A system of privatized family banks. My question for you is, he says an exact time frame. Like, do you remember the time frame? We'll give the answer, but it's a time frame, and it's different for everybody. It depends on where you're at financially. I've seen people do it in 4 years, 14 years, 10 years, 15 years. So this kind of depends on where you're at and what financial freedom means to you about being able to run all your income through your policies.
And as far as the funding things for expenses, like that's not something we typically ever recommend IBC for, is to fund things that you would normally never have interest tied to them. So think of food, clothing, those kinds of things. There's no interest tied to those things. So you wouldn't really want to take a loan out of your policy, incur interest to pay those expenses, and then have to figure out, well, how am I going to pay back that loan? Because now you're incurring interest on transactions that don't have interest otherwise. So we typically don't recommend that you should do that. One of the ways you can do that, though, or do something similar, that is through a HELOC. And that's what Joe talks about, is how you use a HELOC to funnel all your money through, so that you're actually paying less on the HELOC interest-wise, you're capturing the money, etc. But that's Joe's arena, but that is one way you can do that.
The question makes sense, though. It's like, if I put all of my money in, how do I pay back my loan? So it definitely makes sense that you think that. March Realtor Fashionista is saying, have you heard of FEG, Freedom Equity Group, selling IUL? Can I use this for IBC?
Oh, Chris.
Okay, put Chris. Put Chris
out of his ear.
Chris has got it.
Chris, make Chris big.
Oh, you can't hear him. He was so
muted.
he was so happy a second ago. He got lights on. Oh, now Sean is big. I'll keep talking until you get Chris back. There he is.
I had to mute it. That's all I have to say. Someone else want to take a stab at this one, because I just can't.
I want to save it for you. I'm not going to say nothing.
Yeah, IULs are not infinite banking. They are a financial product. They are not infinite banking. We do not use IULs. We do not talk about using IULs for infinite banking. And in fact, a lot of people that talk about IULs for infinite banking are saying things that we don't believe are correct. So that's a very surface level answer. But I know Chris has some, I don't know what he's pulling up right there, probably the contractual language of an IUL.
Okay, I'll say
we don't have time for that. What this is the IBC practitioner program. So the IBC practitioner program is what it takes to become an IBC practitioner. There is an entire section in this book that outlines why IULs should never ever, or VUL should never ever ever be used for the infinite banking concept. And I've also done 6 videos explaining this. So I just, I don't even know what to say to be nice about it.
Well,
anymore.
why don't you say, I know what you can say to be nice to it. Why would somebody think an IUL is like IBC? Like, why would somebody who does not you, who doesn't know what you know, think that these are alike?
And March doesn't know,
Because
right?
being sold a bag of lies. And I don't know how else to be more honest. We just had a guy, Mohammed, on our wealth webinar. I don't know Mohammed. I know nothing about him, but I was talking about IULs on the wealth webinar. Okay. And he said, I have an IUL. I'm losing significantly. It has not performed anywhere close to what the hypothetical illustration showed. As of right now, I've lost $30,000. If that's what you want, if that's what's the name of the company? Freedom Equity Group is selling you, and you buy into that bag of lies, then have at it. Or learn what is wrong with IULs. Learn why. None that I've ever seen. I've seen well over 100 IUL illustrations. You know, not one of them Not one of them that have been enforced have ever lived up to the hypothetical. Chris Kirkpatrick, another gentleman who used to be the #1 IUL salesperson in this country, he literally, all he does now is whole life and what we do, but he literally put a challenge out, and I doubled this. I said, I'll match for $5,000. Like, that's not a small amount of money for most people. And I'll put another 5,000, 10 grand on the line. If any IUL agent or company like Freedom Equity Group can come to us and show a real client, and there was some rules, real client after 5 years or something, or 10 years or whatever, that has actually outperformed the stated illustration, the hypothetical illustration, and not one person, this has been going on for almost a year, not one person has come forth to claim the 5 or 10 grand, not one. So if you're into fast talking salespeople trying to make big commissions, selling you a bag of lies, sounds like Freedom Equity Group is a great company.
That's what I wanted to try to go into, Chris. Let's tell March why companies are selling IULs, why agents are selling them.
Because it's simple. Because why the companies are selling IULs? Why are they such a prevalent thing in the marketplace? Why is it that that's all you hear about? Well, number one, if you're hearing about something a lot, it's probably because it's profitable for the company, but it shifts all the risk from the insurer to the insured, you. Mm-hmm. So an IUL shifts all the risk from the insurance company onto you. That sounds like a win-win for an insurance company. So why is it such a big popular thing for the insurance agents and the financial advisors? Well, same thing. If it's the most profitable thing from the insurance company, where do you think they spend all their time, energy, and training for their agents on? The most profitable product. Sometimes all you need to do is just look past the nonsense and look at the truth, and the truth always ends at the dollar. So what's most profitable for insurance companies? Term is #1 most profitable product they sell. And I don't know this to be fact, but I would assume IULs are probably right up there in a close second place. Otherwise, they wouldn't be sold and talked about and pushed and advertised so heavily. But if they were so good, they wouldn't have had all the regulations come down on them as much as they have, because it's been constant. There's constant regulations, and I don't have it in front of me, but I did it. Thank God I did a YouTube video literally outlining all the regs that have come down on IULs because they don't do what they're supposed to do. And I will fight with anyone about this. Anyone.
And the other, and one thing that has been mentioned, kind of mentioned, but not explicitly, is with an IUL, it is not you, the owner of the contract, that's in control. Like the company, the life insurance company that holds that IUL can turn the knobs on you. They can turn down the amount of the max that you can have. They can turn down your, what's the second piece they turn down? The percentage, right? So they can change it. Like if there's something where they're paying out too much and they need to adjust their things to make their books better, they can do that. With a whole life, you have a guaranteed contract that tells you this is how much it's going to grow. It'll never be worth less. Every day it grows more and more and more and more. Like you're never going to have a day where it's losing anything, where an IUL you can. So you're playing a risky game when you're not in control. So
yeah, I even had a acquaintance of mine on a call, and he goes, "Oh yeah, I'm going to start talking about infinite banking and stuff." And I was like, "Okay, what kind?" He goes, "Well, IULs, I think." And I'm like, "Oh no." And I said, you're going to start talking about IULs to people for infinite banking? He goes, "Yes." And I said, have you studied infinite banking? And he goes, "Well, I'm getting into it." I said, "Well, you're going to come across, if you go to the Nelson Nash side of it, which is where it all came from, IULs are not there. In fact, it's the opposite." He's like, "Really?" And then I said, "Let me show you an illustration." I showed him an illustration of a whole life policy. He goes, "Oh, but the IULs look so much better." And I was like, because they can do that. They can change the percentages, change the numbers. I can't change these ones. I can't, but they can on that side. So what do you think they do? They change the numbers to make them look better than they actually will be.
Which ties right back into the regulations Chris was talking about. The regulations are because of how the IULs are illustrating. They keep having to lower them and change them. And they keep finding workarounds to bring it back to like 7% or a little bit higher. So it looks better. It looks sexier. They're in color. They do all these cool things. Like I wish that's one of the things we've told some of our partnering companies, the A+ rated or better, mutually owned, dividend paying, whole life companies, like make your illustration sexy. It's a wall of black and white numbers. Like let us at least compete with the sexiness of visual learners. But it's just what it is. Like you just have to educate yourself. We want to
Yes.
teach you how to fish. That's it. We want to teach you to fish, then you got to do it.
Well,
One
part
of
of
the things that-
part of the part of
somebody sorry, real quick. If somebody wanted to do IULs, just learn derivatives. If you can fully understand derivatives, then you should buy an IUL. But until you understand derivatives to a very finite level, stay away from it. Anyway.
Yeah, I was just going to add, Chris, that if you believe the market is going to be consistently 7, 8, 9%, because the average returns, I mean, the S&P 500 over the course of from 1928 to year 2022, it's average 7.65. So they use all the what I call funny math because they're basing this all on averages. However, be rest assured, they always tell you that when the market's down, you're still going to be protected. That 0% floor, you're not going to take a loss. They fail to mention, though, that something happens every time you have a birthday cake. Guess what happens every time you have a birthday cake? You get older. What happens when you get older?
Rats.
The cost of insurance goes up. So let's just say, and I don't know if it's ever happened, being kind of a smarty pants here, but if the market's down and you just had a birthday and there's no growth in the policy, where's the cost coming from?
Your pocket.
So are you telling me that the 0% floor thing I've been told all these years isn't true?
Absolutely.
All right. Case closed. Next question.
You should just believe everything everybody tells you. Don't question anything, especially if it's being told to you by a financial advisor. It's obviously going to be the truth.
Tess is getting younger.
And I'm with Tess saying hang around this campfire and learn before making a decision.
Yeah.
But for March anyway, just to wrap this up, I mean, we might have been a little abrasive on some of the stuff, but at the same time, it's a caution because we see this so many times over and over, people bringing IULs to us, and it's just not working out well for them. So,
to me, when I don't really know much about IULs, but it seems like people think that IUL is the solution. Like the difference that I see is like your answer is the IUL, and then with infinite banking, it's like the answer is you and how you treat money and what you do with it. Where like you're not, I don't know. There's just a difference there.
No, that's very, very good. Very true right there. Yeah. Because, yeah.
Very simply put. Well done.
Yep.
I don't even know what that is. Cosmic G burst. I have several IBC policies, but I'm looking for a money tree. Craig mentioned that the other day. What I'm thinking is a policy design that allows a term PUA rider to be increased later in the policy life.
Craig will be a good one to answer this, but I mean, the only way to do that would be to overbuild the policy from day one. You can't go back and add more beyond, the amount the policy set up if it's built to the MEC line. So, but if you overbuilt it, and we've done this rarely, but we have done it before, where you overbuild it to include a term rider that gives you more term death benefit that allows you to put extra money in, but you don't fund it up to the max from day one. Because maybe, a life event's happening in a year or 2 years and you want the ability to do that. But if that life event doesn't happen, just realize you could be severely affecting the efficiency of the policy in later years. Craig, anything you want to say on that?
Well, I think you covered it, but the way we kind of look at this is if you're going on vacation, let's say I'm going to go on vacation, I'm going to buy a seat for Brian, for Jason, for Joe, Shauna, Linus, you can show up too, Chris. And I buy all these plane seats, and then none of them show up. And
they're not going to be my friends anymore.
They're not going to be my friends anymore. But I bought all these plane seats, and I'm not using them. So I reserved all this space for them that they're not using. And that's kind of the same thing you can do with the policies. You can create room for later, and if you don't use it, it ruins the efficiency of the product. Now, with all of that said, there are some ways we can construct this where there isn't a lot of additional cost, where we can still put more in later. I would just recommend getting on a call with one of our money mentors, and we can chat through that for you. But we should be able to do something to accommodate your design that you need.
And
probably
Chris,
done that
what you and Chris mentioned already, like this, it can at times be the most effective. Like if you're like CW angle or someone that might be a little older, and depending on what you're in, there's going to be, and it depends because it's specially engineered for you. Like, what is it you're trying to accomplish? How old are you? How much are you earning? These are all variables that are going to affect how we can specially engineer it. So there are times where it might make a lot more sense to put a lot of it towards the base, knowing that if you're doing real estate investments or other kind of investments where you're going to have windfalls, you want to have a place to park it. And, there's certain companies that we work with where you can put additional PUARs in year 1, and then from 2 to 10, it's a different number. So I think the answer is it depends, like always. And there's going to be cases, like I have one going on right now, where it makes more sense to do more towards the base, to have her be able to put in more later on, and just really walk somebody through how that's the banking process.
Yeah, I've done this probably in the last 3 months, about 10 times for some clients that were asking about that. They have like these lump sum deposit they get once a year. They're saying, I want to put into a policy in addition to the premiums, which are ongoing. And so we built them a policy where they could do a $50,000 deposit for 5 years. And so if they don't make it, that's fine. In this one, what it did change on this one, it changed the underwriting death benefit amount. Didn't change their the cost of like the term rider, by the way, but it did change the amount of death benefit they had to get approved for. But it made sense for them. And then another person, they have a huge payday coming in, but it's basically it's a legally guaranteed, I guess they said. I don't know what that means, but they're going to get it in 18 months. And they're at an age where they want to start a policy today and not wait 18 months. And so we built a policy where they can do the dump in at a different time. Actually, it's a year and a half down the road. So it's the same kind of structure. So it's just, they're very flexible, but it needs to be, as Jason said, built specifically for you. So I recommend obviously hopping on a call to go through that if that's something you want to do.
Yeah, Brian, and those are really powerful designs because it offers all that flexibility. And just to reiterate the point, if you get to that 18th month and you don't have it, you don't have to put it in. So
Correct.
it's not required. But the other thing, it's like a teeter-totter where the more you put in earlier, it's going to not allow you to put in as much later. And so that's what Jason was talking about, where we're putting more towards what we call the base of the policy. So if you want to be able to put in more later, then these kinds of designs aren't as optimal for you. And that's why it really requires a discussion to kind of dial those things in for you.
Yep.
And hopefully that gives everyone here that's just heard all of that, all the people talking, like all of us talking about how we can specially engineer these for you. It's really about you and where you're at in your financial journey and what you're trying to accomplish. It's not ever about us. We get excited and geek out when we can come up with solutions that work for you. Right? Like Linus is one of that way, over there. Linus is like one of the best, and Craig as well. And we're all getting better every day, but he's one of the best engineers as far as really looking at the details and really making sure, like, hey, does it make sense to have this drop off in this number a year or this year? Like, we're really going in for every single one. There's thousands of them, but every single one, we're dialing them in to make them exactly what you want to have happen, right? So,
yeah, something else I would mention to Cosmic Egg Burst, I think is what it says, is that every single policy we design does become a money tree. There's no requirement to have that initial dump in that first year or the extra PUAs that I think you're mentioning later in the policy life. It becomes a money tree whichever way we design it. That's just simply what's going to happen when we design a banking policy here at the Money Multiplier.
Yep. Yeah. And I guess to that point, that's a really good point to bring out. Every policy is a money tree. It just depends on, is it year 2, 3, 4, or 5? And you might even look and go, well, gosh, my policy's not a money tree until 5. Is that bad? No, we may have designed it that way so you can put more in later. So just know that all these things, there's not one thing that's always better than the other. It just depends on what you're trying to accomplish. So sometimes that money tree happens really quickly, and sometimes it's going to be a little bit delayed. And it just is all based on us fitting a design for your problem that you're trying to solve.
And if there's a dump involved, and health also too. So.
Yep.
Because I built a money tree in 2 and 3 this morning. So it just depends.
Young Titus is saying, got a question on the loan part. Can you take loan totaling over the cash value? Like if I have cash value of 10,000, can I take 2 to 4 loans where that is a total over 10,000, or is 10,000 the limit?
Before we dive into that one, for Cosmic Egg Burst,
Mm-hmm.
there's a link there for the Mentors Be Your Own Banker that you can schedule a call, have the conversation. Just we'll help you prep for that as well. We'll give you some guidance on how to come into the call fully prepped, and then once you get there, we'll meet you where you're at and we'll help you navigate that and come up with a design for you. So
yeah, mentors.beyourOwnBanker. Oops.
I'm sorry.
No, it's okay.
I was trying to.
Mentors.beyourOwnBanker.
now back to the program at hand. What was the question again?
So if you have cash value of 10,000, can you ever get more of that in loans, whether you take out 1, 2, 3, or 300?
It's not a magic pot. You can't take out more than what you put.
Yeah, whatever's there is there. That's basically it.
Well, I mean, if you're talking about the cash tree part, if you put 10 grand in, it's a cash tree, you might have like the start 10,500 or 11,000. So at some point, it actually becomes magical that way, but just not initially, right?
Yeah, whatever your cash value is in the policy today, you can take out.
Yeah.
Mm-hmm. And you can take out as many loans as you want, right? Like
as long as it's cash value. Yep.
Up to what's available.
Yeah, up to what's available. Okay. Yep. And then I like what Damon is saying is I don't know what a IUL is, but I know what you guys are teaching is real to me.
I love that.
It's something I think we need to reiterate what young Titus is asking. And I'm sure we all get this question, or people are surprised when they find out. If I put in $10,000 into a policy, and let's just say it has a $300,000 death benefit, there's still people out there that believe they can take a loan for $200,000 because of $300,000 death benefit.
This is true.
And I've had to have some pretty firm conversations with people to explain if that really worked that way, how long would the insurance company be in business? Because if I put $10,000 in and I can take 300 out, their doors would be closed tomorrow. So we always have to remember that the death benefit's there. We get an advance of that death benefit. That's what your cash value is. And some portion of that is what's available for a loan. And then what Shauna mentioned, you can take as many loans as you want up to that available cash value, but it's not going to be above that or beyond that. And your cash value is going to get bigger every year. As you put 10,000 in, you might be getting 11,000 back. So all those things are magical. That's where the magical pot comes in.
Usually in year 11.
And Joe, you and I both laugh because we both had those conversations with someone who's like, "Hey, I want $1 million death benefit, and I want to borrow against that $1 million." It's like, how?
More than I can tell you. Yeah.
Teach me how you do that. I want to know.
I would have been the first one to do it though. So
yeah, same, right.
Yeah. So I think it's just one of those things that's important to understand. That's not part of the process, but I'm not saying young Titus was thinking that. I just wanted to share that point because it comes up often.
Perfect.
Yes, and for March earlier, I still feel like March got a lot of what she feels, because there's a lot of like angst and frustration when it comes to IULs here.
Trigger word.
And so March, that wasn't directed at you at all. We love the fashionista tag. I would say it's more that we literally see people suffering and getting screwed and taken advantage of on a daily basis. And so if we fight for people in the truth, like it's really hard to say like it's almost impossible for us not to say what the F. Like Chris is at the point, he's been doing it so long, helping people, serving people, where he just like it's F-bombs and the swear jar is filling up. That's just how it works. So
dude, it
came back.
Yeah, dude, it's almost like IULs are like big pharma and saying, take this pill and you're going to be fine. We're the people saying, get off your ass and fucking work out and do this or that or the other thing. And it's on you, bro, to get the future that you want. Like that
is it. It is the magic diet pill. It is look at this. You don't have to work out. You can keep eating all that crap. You don't have to walk. You don't have to move, and you will look like this, and they'll have a model there. You will look like this. This just doesn't it's not how it works.
All right, we got 3 minutes left and 2 questions. And I'm going to try to share my screen real quick too, because actually for March and a couple of the new people. Oh, never mind. My computer crashed and all my permissions are disabled. But we have a new show starting on Tuesdays next week, which is going to be really like, I know if you're here, you probably know us a little bit already, because otherwise I don't know why you'd be on our YouTube or on our Facebook. But we have a new show on Tuesdays that's going to really go back to the basics all the time and be there for you on Tuesday for infinite banking. And then on Wednesday, the Wealth Wednesday webinar with Chris will be, a step more advanced. And then of course we're here after all of those shows for Ask Me Anything again.
Okay, thank you, Sean. And we're super excited about that. Some of us are going to talk too fast. Some of us are going to talk too slow. Some of us are going to wave our arms around like this when we do it and click and pop and do all kinds of stuff. So you'll get a different flavor, whoever you're going to resonate with. It'll be the same type of presentation. We'll do the hokey pokey together, but it's going to be fun. So
that's actually a really good point. So you're going to hear about infinite banking, the machine and the basics and the fundamentals, but you're going to hear from it from so many different perspectives. So it's totally going to sink in so well. So come on Tuesdays. Yeah. You get Jason's flavor, Brian's, Chris's, Steven's, everybody else. It's really cool.
And I'll just add, though, those are really great sessions. If you have coworkers or family that you want to get introduced to this type of a concept, that's the place to go, because they can start hearing it over and over and over. Because a lot of the wealth webinars we do, like the one Chris did today, kind of dove in a little bit deeper than most people would want for an introductory infinite banking concept. So yeah, come back to, Take Back Control Tuesday, and we'll go over the basics.
All right, final two questions here, guys. So CW is saying, I'm 66 years old and have $450,000 in an IRA I won't be using until forced by our government. How can I utilize this money for an IBC policy?
Not financial advice. Well, you can since you're over 59 and a half, obviously contact the IRA custodian first, but you can withdraw the money out. That's typically a taxable event in most cases. And then you can put it to work at IBC. Any one of us can walk you through how that would look for a policy. So I'd recommend scheduling a call with one of our mentors.
Yeah, and one of the strategies to think about is, so now you've got this $450,000 IRA that you don't want to use it because you're going to get taxed on it. And the challenge is, if that were to get passed on to the next generation, let's say you have kids and they're at the height of their income producing age, that money that's going over to them now is going to get taxed at an even higher rate because now it's taxed on them. So one of the strategies is you can start taking the money out of that IRA now, just pay the taxes on it, put it into policies, which will then get it into a tax-free environment or tax advantage environment. And when you finally graduate or pass away, as we call it, then just think of the multiplier that money is going to be on top of your family. So it's just a beautiful strategy to take that money, pay the taxes on it, get into a policy, use it while you're alive, and then the rest of it goes to your family.
Yeah, that's a great idea. And Craig, I'm sorry, I might have caught some of that. I was sending an email. Did you mention SPIA? Is that what you mentioned, though?
No, I was just talking about, we can talk more about that, but I was just kind of giving the high level of taking the cash, paying taxes, putting into the policy, or you could do the SPIA.
You might as well try to get an insurance company to pay some of those taxes. Why not? An easy way to do that. If you don't need liquidity of any of that money, I did that retirement presentation back a while ago, but you could pair that strategy, the withdrawal strategy, where you're moving money from qualified retirement plan into an IBC, which is a tax-free environment. Doing it, you're just going to pay taxes on a little bit each year. But if you moved a portion of it, rolled it into a qualified, they call it a SPIA, single premium immediate annuity, the interest rate that you earn on that is really good and it's guaranteed. And then the insurance company funds the policy for you, but you get interest on that money while it's funding it. That's just another add-on strategy that you could look at. The only downside is it does lock that money up for the period of time that it's funding the whole life, but it's kind of a moot point because you're taking money from the IRA and you're funding the policy, which has immediate liquidity. So really, it seems like it could be a huge fit, seeing as though you're saying you're not going to be using it until forced to by the government. Don't wait for the government to force you to start paying taxes. Put the middle finger up to the government and say, I'm going to make the insurance company pay the taxes to you. And that's how I would do it. We'd have to run numbers, but that's a good way to do it.
Yeah, I think was it 2 weeks ago you did that retirement strategy wealth webinar, or 3 weeks? I don't know if we have the links to that, but that would be an awesome video for CW Eagle to watch if we could dig that up.
And then real quick, Roxanne was asking what time on Tuesday. All of our shows, so Money Club Mondays with Steven is at 1 p.m. Eastern. This Tuesday, Take Back Control Tuesday is 1 p.m. Eastern. Wealth Wednesday webinar is 1 p.m. Eastern. And on Thursday, Noah's Quick Start for Private Money Club, so private money lending and borrowing, is also at 1 p.m. Eastern. So we're trying to get the same block of time in your life every single day is what we're trying to do. And final question today is from Eve saying, is the One America design your group was working on completed, or is it still in the process of being designed?
The thing I've discovered with the Rock is that it's typically the same as the Beast. It's just sometimes there's just a little bit more that they can squeeze out than what we could. So, yeah.
Good call.
And Shauna, just real quick, I put in the private chat the links. I don't know if you can share that out, but I think that's.
I got it.
I think that's one.
And if it's not, there's a playlist on Chris's YouTube channel that's called like probably Wealth Webinar Zoom replays or something of that nature. That's where you can find every Wednesday. And so like today's video will be uploaded to YouTube on Saturday. So you can catch up pretty much at any point there. All right.
I want to make one comment. So Raymond, Ibis, so actually I just reached out for your policy. We revised the numbers like we talked about a week or so ago. And so they're reviewing the revised numbers, the underwriter is, but I'm pushing them to get us a decision on those revised numbers. So FYI.
And we did it. Another Ask Me Anything episode comes to a conclusion. Remember, if you're enjoying the content here, go ahead and smash the like button, subscribe if you're new, and ring the bell to be alerted for new content. Watch the next video right here that's going to help you on your infinite banking journey, and I'll see you soon.